One of the most popular concepts in modern price action trading is the fair value gap, or FVG. You've probably heard traders talk about it, but what exactly is it and why does the market react to these zones so often? A fair value gap represents an area where price moved so aggressively that it left behind an imbalance between buyers and sellers. Many traders believe these imbalances act like magnets, attracting price back before the trend continues. In this video, I'll show you exactly how to identify bullish and bearish fair value gaps, explain the theory behind why they work, and most importantly, how you can use them as part of your own trading strategy. Let's jump into it. Let's start with a bullish fair value gap. A bullish FVG is simply a three-candle pattern. First, we look for a strong bullish candle that's significantly larger than the candles on either side. Next, we compare the candle before the impulse move with the candle after it. If the high of the first candle does not overlap with the low of the third candle, a price gap is created between them. This area is called a bullish fair value gap, or a bullish FVG. To mark it on the chart, we simply draw a rectangle from the high of the first candle to the low of the third candle and extend it to the right. As long as price stays above the bottom of this zone, the FVG remains valid. When price later retraces back into this area, many traders expect buyers to step in again, potentially leading to another move higher. But why does this happen? The idea behind fair value gaps is based on market imbalance. A very strong impulsive move usually means one side of the market completely dominated the other. During that move, price travels so quickly that very little trading takes place inside that gap. In other words, the market doesn't spend enough time there to establish what many traders consider a fair price. As a result, when price eventually returns to that area, buyers and sellers often become active again, trying to complete the unfinished business left behind during the impulse. That's why these zones frequently attract price. Before we move on, let's take a look at a bearish FVG as well. A bearish fair value gap works exactly the same way, but in the opposite direction. Instead of a large bullish candle, we look for a strong bearish impulse. If the low of the first candle doesn't overlap with the high of the third candle, we have a bearish fair value gap. We draw the zone between those two prices, and when price later rallies back into it, the area may act as resistance and provide a potential selling opportunity. As I said, very often, price is attracted back to an FVG, reacts inside the zone, and then resumes the original trend. Let's look at some examples. Here, the market makes a strong impulsive move to the upside, creating a bullish FVG. Instead of continuing higher immediately, price retraces back into the fair value gap. Notice how the entire shaded area represents the imbalance left behind by that impulsive move. As price enters this zone, buyers begin stepping back into the market, preventing price from falling much further. After spending some time inside the fair value gap, the market finds support, resumes the bullish trend, and eventually breaks above the previous high. This is exactly why many traders pay close attention to fair value gaps. They often act as dynamic support zones, where price is attracted back to fill part of the imbalance before continuing in the original direction. And here's an example of a bearish fair value gap. After a strong bearish impulse, the market leaves behind an imbalance. Price later rallies back into the fair value gap, where the zone acts as resistance. Sellers step back into the market and the original downtrend resumes. Just like a bullish FVG can provide support, a bearish FVG can provide resistance and offer a potential short selling opportunity. Price doesn't always return to a fair value gap immediately. Sometimes it takes much longer before revisiting the zone. That's why traders usually extend the fair value gap to the right and simply wait for price to return. Here's another example. Even though price stayed away from the fair value gap for quite some time, it eventually returned to the zone. The FVG acted as support, buyers stepped in, and the market resumed its bullish move. Here's the bearish version of the same concept. Price rallies back into the bearish fair value gap, where the zone acts as resistance. Sellers regain control, and the market continues moving lower in the direction of the original trend. It's important to understand that an FVG is not a magical signal that guarantees a reversal. Of course, not every fair value gap works, which is why it's always best to combine them with other price action confirmations or technical analysis rather than trading them in isolation. The strategy I'll show you combines three powerful concepts: two overlapping fair value gaps from different timeframes, plus a price action confirmation on the lower timeframe. Together, these significantly increase the probability of a successful trade. Now, let's look at a real example of this strategy in action. As you can see, we're currently on the 4-hour time frame. Price is sitting near a major support zone identified by this horizontal level. Since we're at a higher time frame support, our initial bias is to look for buy opportunities. If we zoom in, we can also identify a bullish fair value gap in the same area. Let's mark this FVG by drawing a box around it. Next, we'll identify our initial profit target. A simple approach is to use the 50% retracement level of the current move as our first take profit target. Now, let's move down to the 15-minute time frame. At this stage, we simply wait for price to retrace back into the H4 fair value gap. Eventually, price returns to the zone. But here's the interesting part. We now discover another bullish fair value gap on the 15-minute chart, and it overlaps with our H4 fair value gap. This overlap creates an even stronger area of interest. Now let's move down one more time to the 5-minute time frame and wait for price action confirmation. Here, price reacts to the overlapping fair value gaps and gives us a strong bullish confirmation. This provides a high probability buying opportunity. For the stop loss, you can place it just below the 15-minute fair value gap, or more conservatively, slightly below the 4-hour fair value gap. For our take profit, we simply return to the 4-hour chart and use the 50% level we identified earlier. And as you can see, price reaches our target with ease. One final reminder, before looking for overlapping fair value gaps, always start with a higher time frame to establish your directional bias. The fair value gaps and lower time frame confirmations should only be used to refine your entry, not to decide the overall market direction. Now, one important point to remember is that we can't simply trade every fair value gap we see. A single FVG isn't enough. We want multiple layers of confirmation before risking our capital. Yes, waiting for these high-quality setups requires patience, but that's exactly what separates professional traders from everyone else. Now, let's look at another example to reinforce the concept. Here we're back on the 4-hour time frame. We can clearly see that price has previously bounced from this horizontal level, making it a strong support area. We also have a bullish fair value gap forming right inside that support zone. As before, we'll mark the fair value gap and use the 50% retracement level as our initial take profit target. Now, let's move down to a lower time frame, in this case, the 5-minute chart, and patiently wait for price to return to the H4 fair value gap. Eventually, price retraces into the zone, reacts, and creates another bullish fair value gap on the lower time frame. This gives us the additional confirmation we've been waiting for. A few candles later, buyers start taking control. An aggressive trader could already enter the trade here. A more conservative trader, however, may prefer to wait until price breaks above this recent swing high before entering. Once that breakout occurs, we have a strong confirmation that buyers are in control, making this an excellent location for a long position. For the take profit, we simply return to the 4-hour chart and use the 50% retracement level we identified earlier. And as you can see, price reaches our target once again. One of the biggest advantages of this strategy is its excellent risk to reward ratio. Because our stop loss is relatively small while the target is much larger, even a moderate win rate can produce very strong long-term results. What's also interesting is what happens afterward. Notice how price continues to respect this overlapping fair value gap area, reacting to it multiple times. This repeated reaction adds further confidence that overlapping fair value gaps can become highly respected zones in the market. We've got many more trading lessons coming that will help you become a better trader. So So don't forget to subscribe, and I'll see you in the next video.